Thanks for joining us today on Market Call. I'm Morella Fernandez. Lorne Steinberg with us on the show, president of Lorne Steinberg Wealth Management, taking your questions today on global value stocks and high-yield bonds. Here is how to reach us today, 1-855-326-6266. If you're dialing in, you can send your questions in as well to marketcall@bnnbloomberg.ca. Lorne, good to see you. Thanks for coming in.
Great to be here, Morella, again.
You are saying that diversification is back in style. Why do you think that is?
Well, anytime there's a massive sell-off in one or two sectors, and we're seeing it in everything from Bitcoin to software, all of a sudden those boring consumer stocks are suddenly looking like the shining stars. And the message for investors is diversification should always be part of everyone's portfolio, because there's no way investors can react fast enough to reposition themselves when things fall off a cliff, and that's what we've seen happen.
You have seen investors piling out of software stocks. Do you think there's still some value in some of them? What would you pick up today?
So there's for sure value in software. Anytime, the pendulum swings too far in one direction, there are always opportunities created. But certainly for us, the opportunities are in the best of the best companies like Microsoft, Adobe, and we're looking at a number of others as well.
You think that the investor concerns about software being eaten by AI are overblown?
We think they're way overblown, but also a lot of these companies are already incorporating AI, and they are among the leaders in AI. And so they will be using AI, but the reality is the business customers of these companies, they need the whole integrated solution. They're not going to do it on their own.
What are the other sectors you're looking at now that this broadening out is well underway?
So, listen, we've always been well diversified, but certainly, financial stocks remain a core component of our portfolios. We still see a lot of value there in both Canada and the U.S. We see a lot of value in the consumer sector, which has been beaten up for such a long time. These companies are trading at very, very low multiples with healthy and rising dividend yields. Dividends, which should drive value over time. And Morella, I've been around long enough to tell you that in the early 2000s, these consumer stocks were trading at way higher valuations than they are today, and they were the ones that were looking overvalued.
So things have gone upside down.
Exactly.
Okay, let's take a quick break then. We will line up the first phone calls for Lorne, and here is how to reach us, our email, as well as the phone number. We're back with Lorne Steinberg of Lorne Steinberg Wealth Management. I'll take your questions on global value stocks and high-yield bonds. Back in a moment. Welcome back to Market Call. We are going to take an email first from Brian. He says, I'm wondering what Lorne thinks of TRI, Thomson Reuters. The stock has had a big pullback. Lorne, of course, this had to do with Anthropic AI tools coming out. Is this a company where you think they have their own information that is protected and will survive sort of the AI threat that is overhanging other software stocks?
I think there's no question they'll survive the threat. The question is how much will it dig into their revenues? And this has never been a cheap stock. For us, it remains not really that cheap a stock, although I will say the 3% dividend is fully covered. So it's not something we're really looking at. I think with this sell-off we've had, there are better places to be with companies that are better integrated into their customer base. And this one is more also management's lost a bit of credibility on the street, and I think the street would like to see the company announce another share buyback if they have confidence to buy back shares at such a depressed price.
If you have it, would you hold it?
If I had it, would I hold it? No, I think I would sell it and look for other things to buy.
Got it. Okay, let's get to the phone lines. And Ben is on the line. He's in Kingston with a question. Hi, Ben.
Hi, Morella. Hi, Lorne. My question is on Boeing. Is it fair value right now? And the order book is bubbling, but we don't know. Your thoughts going forward. Thank you, Lorne.
Okay, thank you for the question. Let's pull up Boeing and see how they are doing. What do you think about Boeing?
So we're not, Boeing still has a lot of debt, and that's one of our biggest issues with Boeing. Of course, they're in an oligopoly business, and Airbus and them are always fighting each other for orders. Let me say the new management team is doing a pretty good job in turning around this massive cruise ship, if you will. And So it's probably not a bad bet in that sector, but we're not crazy about the sector.
In general?
In general.
Okay. Let's...
It's a leveraged business.
Okay. Let's move on to Frank then. Frank's on the line today in Toronto with a question. Hi, Frank.
Hi, Marella. Hi, Lorne. My question is regarding Blue Owl Capital. I've been watching this for about a year now. Is it in his radar? Is it a good time to buy? What does he think about this company, Blue Owl? It's been beaten up. This sector has been beaten up for a little while now. His thoughts on that. Thank you very much.
Thank you for the question.
Thank you, Frank.
Blue Owl. So private credit, is that essentially what they do?
That's essentially what they do, and private credit is not exactly in favor right now, as we've had defaults with First Brands and a number of other major borrowers in the States. And this has always been a very opaque business, Morel. It's very hard to understand what's going on under the hood. So we would stay away, and our view is if the economy slows down a bit, the private credit sector could get way worse than it is today. And there are just many other better places to be.
Do you own anything in private credit, or do you stay away from that whole section?
We stay away from that whole section because it is just impossible to do proper due diligence on those companies and honestly know what is going on under the hood.
Okay, so something you stay away from entirely. All right, let's go to Chris. He's in Delta, BC. He's got a question. Hi, Chris.
Oh, hello, Marella and Lorne. Lorne, great to have you back on the show. I'd like to ask you about Berkshire Hathaway and just stepping back as well. If you were a 30-year-old investor, 10-plus-year time horizon ahead of you, and you were looking for an investment potentially like Berkshire Hathaway to buy, not trade, and just consistently dollar cost average into or buy and hold for the long term, I'd be curious to know if you'd have any suggestions. Thank you both and have a great week.
Okay, thank you for the question. Berkshire Hathaway has been off since the announcement of his retirement for Warren Buffett, and everybody thought it would come back. It hasn't really. I'm wondering if you're invested in it and if you like it moving forward.
So first of all, we're invested in it. Warren Buffett is one of my all-time heroes, so how could I not be? And the reality is, listen, it's tough. Greg Abel is the new guy, even though he's been there for over 15 years and is the hand-picked successor. He's operating under a microscope, and the first big acquisition he makes will be
very much scrutinized.
Very much scrutinized. That being said, it kind of reminds me of when Steve Jobs had to leave Apple. There would never be another Steve Jobs, and this guy Tim Cook came in, and he's not a visionary, and yet he didn't try to be Steve Jobs. He put his own imprint on the company, and now people are worried about what happens when Tim Cook resigns from Apple. So Berkshire Hathaway owns a phenomenal collection of assets. Greg Abel has been there for a long time. The insurance operations agent Jane continues to run them, and we think Berkshire is that company you can hold for a long period of time.
Okay. Let's go to an email from Allie. Allie says, I'd like to hear your guest's view on Salesforce, CRM, again with the software concerns. And I know the understanding is that some of these, as you mentioned, are so embedded in systems that businesses will carry on using them. Is Salesforce one of those?
So I think it is. And by the way, we use Salesforce. Not that that's going to mean anything to Salesforce or investors. I have to say, so we don't own Salesforce. It always looked like a rather fully valued stock. I have to say, now that it's trading for 16 or 17 times earnings with that massive free cash flow, it's actually on our radar, and we have a discussion about Salesforce next week. And because it certainly looks like it could be a very attractive stock. Tell
me a little bit more about what they provide for your company and others.
Sure. So everyone in our company who deals with clients, either on the marketing business development side or just dealing with clients in general, every conversation, every meeting you have is logged into Salesforce. So if my meetings are logged in and I happen to be away for 2 weeks and a client says, I spoke to Lorne, 2 weeks ago, and he told me he was going to do this, my colleagues can look right into Salesforce. There are all the notes. They know exactly what is happening. Also, for follow-up with people, I'll call you in 4 months' time. That, hooks right into your Microsoft Outlook, if you will. And so it makes everybody so much more efficient, and also is a phenomenal tool for business development, but also on the client service side, we can't live without it.
Okay. Good to know. Let's take a quick break. We will get to more phone calls and your emails when we come back. Stay tuned. Welcome back. Let's go to an email from Howard. He says this company, BCE's fourth quarter results were considerably more positive than negative, yet the shares took a bit of a hit. Does your guest agree it's a buying opportunity? And BCE, will remind people, is the parent company of this channel under the Bell Media brand. Shares did fall yesterday after the company reported. What are your thoughts on whether or not he should dip in at this point and pick it up?
So for us, we like BCE at this level. We own BCE at this level. The dividend is absolutely secure. They're throwing off additional free cash flow, which we'll probably use to reduce debt somewhat, and there's room to invest in some growth. And again, this is a defensive stock. It's not a growth company at the present time, but we think it will serve investors well and deliver possibly that double-digit return from here over the next number of years.
And your finance perhaps legging in where it is today?
Oh, very happy to leg in where it is today.
Got it. Okay, let's go to John from Milford, Ontario. He's got a question and he's on the line. Hi, John.
Hello, Lauren. I would like your thoughts on Arc Energy. I see it's taken an awful hit today. Is there any news behind that? Thank you very much. Bye.
Yeah. That was the Hitachi BC report that they're having some challenges there, which is weighing on the stock very heavily today. You can see it's down almost 13%. It's been struggling for a while. What are your thoughts on ARC Resources?
I mean, ARC has been an underperformer for a long time. And, you know, if you want to own energy in Canada, we think there are better places to be. We also think with low oil prices, one should focus on the upper tier companies. So the company we would focus on, honestly, Morella, is CNQ, Canadian Natural Resources, which, by the way, has delivered, you know, dividend increases every year since it started paying one over 20 years ago. Far more stable income stream, but also a low-cost producer. So unlike ARC, you know, CNQ is profitable at $40 oil as an example, and it's, you know, we're not overly bullish on long-term oil prices over the next few years, so we would prefer that play.
What about the natural gas space? A lot of people are looking at ARC for that, thinking that'll get online sort of in the next year or so.
And for us, it's going to take a long time for natural gas really to be able to expand and build LNG facilities, which would really give Canadian natural gas players the opportunity to sell gas at higher prices. So we think it's just too early.
Too early. Got it. Would you hang on to it if you were already in it?
I would look for something else, honestly. It's like ARC has been in a tough place, let me say, for a number of years.
Okay. Let's go back to the phone lines. And Pavi is on the line in Calgary. What's your question today? Pavi, are you there?
Yeah, good morning to both of you. Just want to know your thoughts on TELUS.
Okay, thank you for the question. TELUS, also telecommunications. What are your thoughts on TELUS and its growth prospects? Because it's one in the industry, like many, that have been beaten down.
Sure, and so we like the sector in Canada, and we own TELUS as well. Again, you're getting a great dividend, and at these dividend yields, you don't need a lot to go well to deliver a pretty good return over the next number of years. We think a lot of these stocks are washed out. These companies have all cut costs, and they're positioning themselves for better earnings growth, despite the fact that revenue growth will be somewhat muted. We're also looking for slightly increased prices in the Canadian telco sector. Not great for consumers necessarily, but you know, way overdue. And that should give a bit of a boost to these companies the next couple of years.
What about the ability to diversify? All of them are trying to diversify and find new business. They're all trying to go about it in a different way. How is that working for TELUS?
I mean, TELUS has done a couple of really good things in the past through, you know, diversification and spin-offs and that kind of thing, probably more successful than others. It's always questionable because you tend to get yourself into businesses you don't know as well. And this has been going on for years, by the way. But we think that the real opportunity is sticking to the knitting at this point in time and focusing on telecommunications, and which is what BCE is doing, despite the fact, you know, they're doing that south of the border as well. And that's the opportunity. But at these beaten down prices, to get a 10% annualized return for the next few years, we think is very achievable, including the dividends.
Got it. Let's go to Mark on the line in Gatineau, Quebec. Hi, Mark. What's your question?
Yes, good afternoon. Thank you for taking my call. Yeah, Lauren, I'd like to have your thoughts on Knights Therapeutics. Unfortunately, it's been in the dog pound there for about 6 years since COVID. So what's the value on it? And you think it's a good little pharma play? Thank you kindly. Have a nice weekend.
Thank you for the question. Knight Therapeutics.
It's a Montreal-based company run by Jonathan Goodman, who has had a massive success in his previous endeavor, and a very bright fellow. But so this company buys existing drugs that are kind of orphan-type drugs and then markets them in Canada and in Latin America. There is value there. I think the market is, looking for some better consistency on the earnings side. The way they deploy cash to continue, those opportunities still going to be there to buy up these orphan drugs that the big companies don't want, and to be able to market them. So from an earnings perspective, I think it's less of an earnings story and more of an asset story. And but it looks like a cheap stock, I must say.
Okay, would you pick it up at this point?
We're not there at the present time, but it's kind of like in the background on the radar because it does look like a cheap company.
Okay, let's go back to the phone lines, and Elliot's on the line in Hamilton, Ontario. Hi, Elliot.
Good afternoon. I am most impressed by the management of Banco Santander, their laser focus on profitability, their open bank online presence, and now their commercial acquisition, Webster's Bank. What's your opinion, please, of SAN? Is it a good buy today? Thank you.
All right. Banco
So
Santander.
we happen to like the banking sector. I also happen to, Europe is also starting to get its act together. There'll be some growth there. So we don't own any European banks at the present time. Our bank concentration is in North America, US and Canada. But it's certainly, for European banks, it's something we would look at because they've gotten their act together, let me say. They went through a choppy period post-financial crisis, but the gentleman is right. They have gotten themselves on a better strategic path. That's the kind of thing we'd look at, and there's a solid dividend there as well.
I was going to say, is there a dividend there?
Yes.
There is. So you get paid to hold on.
Exactly.
If that's what you want to do. Okay. Let's go to an email from Dimitri. Dimitri says, I have a question about CN Rail and the outlook of the company for the next 5 years. Transportation badly dragged down last year, coming back this year, but what about rails?
So we like the rail sector because it's cheaper to ship on rail for many goods, including commodities, and they're not building any more rail for environmental reasons. CN management's done a pretty good job operationally. For sure, volumes are flatlining here at the present time. And, one of the things on investors' minds is what happens with the free trade, the trade agreement. That is weighing on the stock because they ship metals, including aluminum and steel as well. Still, I have to say it's 17 times not great earnings. You're able to get into the stock at a pretty attractive price, 2.7% dividend, and, we're happy to get in and own the stock.
That being said, as you mentioned, with CUSMA renegotiation as the overhang and lack of clarity about if any of the trade issues are going to get resolved in the next couple of years during Donald Trump's term, do you have to be prepared to have it sit where it's sitting today?
Oh, first of all, I think a lot of bad news is baked into the stock, and I think the stock is assuming there won't be any great trade agreement. So if we do get a CUSMA agreement, and we think there's a really good chance we're going to get something, that would be a net positive for this company off the bat. So, we think that would be a great catalyst, but we think something's going to happen there, and you're buying it at a very depressed price.
Okay. Let's take another quick break. We will have a look at Lorne's past picks when we come back. Welcome back. Time to go through past picks from Lorne Steinberg from March 6, 2025. So a year ago, about less a month. Let's get to your first pick, Lorne, which was American Express at $275.64 US at the time, now to $358.05. So a return of 30% and 31% total return. We did see American Express and both Visa sort of going sideways for a little while. Have concerns about whether they're going to be replaced by some other sort of digital function here passed, you think?
Sure. I think, first of all, American Express is very different because they've got this unique card business which is differently positioned than everyone else's. And also the nature of their customers are, defaults have been minimal, I have to say. This company has delivered double-digit earnings growth year after year after year. Their last quarter was another strong quarter. And the stock for us remains cheap and a core hold. And my friend Warren Buffett's the largest shareholder. So there you go. But this company has just gone from strength to strength for so many years and, evolved their business over that time.
What do you think they do better than some of the other credit card companies?
So one of the things they do better is they're focused on a higher end consumer often, and at a certain level they're focused on the highest end consumers. So you can spend, over $1,000 for a special platinum or gold card, black card or something that gets you all kinds of things.
Access.
Exactly.
Yes.
And so that is a very, very profitable niche of that business, the most profitable by far, huge margins, and they keep on delivering value to the users.
Okay, clearly people like it. Let's get to your next pass pick. Bank of Nova Scotia, BNS on the Toronto Stock Exchange, 68.88 at the time. Now to 104, 51% upside, 57% upside. They're in the middle of a transition.
They are, and the CEO they brought in from Finning set the strategic plan a couple of years ago. They are executing it. This is a massive company. You're not going to turn around that company overnight. That being said, there is still quite a significant valuation gap, Morella, between Bank of Nova Scotia and the rest of the Canadian banking sector. And we think that over time, that valuation gap is going to continue to shrink. They'll never trade for the same valuation as a Royal Bank, but they don't have to. The valuation gap just needs to shrink a little bit, and we still see this as a core part of every Canadian's portfolio.
Why do you think that gap has existed?
Oh, it's existed because, quite frankly, they've underperformed the rest of the Canadian banks. We're a poor capital allocator. They put too much money into Latin America. A lot of that did not work out well. Mm-hmm. And so they deserve the valuation discount. But now they're coming out of all that. They're redeploying capital into North America and into Canada specifically. We're seeing more Bank of Nova Scotia branches all over the place. I have a new one near me. And they're back to the basics.
Okay. All right, so Scotiabank, one to watch. Let's go to your last pass pick from March. Diageo, DEO on the New York Stock Exchange, 114.19 US, now to 96.71, 15% downside, total return 13%. What has been hitting other liquor and alcohol providers, generally speaking, because it is quite down?
So my daughter doesn't drink alcohol, and that's one of the major problems.
Thing, right?
Okay,
yes.
So all joking aside, but people are drinking less, drinking better. So Diageo's always focused on the premium brands. There used to be Johnny Walker Red and Black. Now there's green, blue,
every other color of the rainbow.
Exactly,
yes.
At much higher prices. That being said, volume growth has been, minimal to non-existent. They have brought in a new CEO who turned around Tesco, the huge grocery store chain in the UK. And, we're expecting some improvement. We think earnings have bottomed out here. You're getting a 14 times earnings, 4.3% dividend stock. So we think it's pretty washed out and pretty safe from here. But this is not the kind of company you're going to turn around, in the next 12 to 18 months. This is a multi-year strategy, low and zero alcohol, more and more beverages like that, and trying to connect with younger people again.
Which never used to be a problem. Now it is. Okay, let's take a quick break. We will be back with Lorne Steinberg of Lorne Steinberg Wealth Management. Again, he's taking your questions today on global value stocks and high yield bonds. Back in a moment. Welcome back. Let's go to William on the line in London, Ontario. He's got a question. Hi, William.
Good afternoon. Do you have an opinion on Cisco or a competitor of Cisco to buy, please?
Okay, thanks for the question. Can you remind us what Cisco does now?
So Cisco is the router company. And now there are a lot more. So they're part of IT infrastructure. but they made a huge $27 billion acquisition of Splunk, which has really helped drive their security business, IT security. And, they're at the upper level of all of those businesses. Now, interestingly enough, Cisco finally hit a new high. Its previous high was March 27th of 2000.
Wow.
Back
okay.
during the dot-com period. We've owned Cisco for a very long time. We think it is a compelling buy. The company has been a phenomenal allocator of capital, Marella, buying back stock every year, raising their dividend every year, and finally growing revenues again. So they've been a rather moribund, slow, low single-digit revenue grower. We're looking for mid to high single-digit revenue growth, which is partly why the stock has started to move again. But they're so well positioned for AI and on the infrastructure side, on the equipment side, with a lot more recurring revenue, a much higher recurring revenue stream, that the stock is, getting back in favor again.
I was going to say, so that's what has led to the revenue growth is the AI build-out.
AI build-out and their acquisition of Splunk, and of course, IT security, cybersecurity is a huge issue for everyone.
But let me ask you about IT security, because again, it's one of those types of businesses that people are worried about with AI, that AI could perform the same function and you don't have to get the service from somebody else.
So I'm not sure AI can actually perform that same function, because every financial firm is spending a pile of money, and our cyber insurance costs are one of our fastest rising costs, as you can imagine. And Cisco solutions are, multifaceted. They're embedded into large businesses. So we're less bullish on, companies employing AI by themselves to replace a whole bunch of things, but they are certainly using AI and will use AI to replace a lot of smaller single processes and probably hurt a lot of the smaller companies. But the larger companies, for us, are here to stay.
Got it. Let's get to an email then from Craig. Lorne, your thoughts on relative value on Goldman? Seems with several large IPOs set to debut for this year, opportunities for the company may be favorable. Would you buy at today's level? I imagine you have invested in Goldman Sachs or are invested in Goldman Sachs.
We are invested in Goldman Sachs. I call them the evil geniuses because they seem to make money in good times and bad, doing all kinds of different things. But certainly under the Trump administration, M&A activity is way up because there's less regulation, less antitrust and all of that. Markets are trading them well. Goldman is the, among the leaders in the whole M&A world, IPO world, and for us, they're impeccably well positioned to keep on driving forward.
Because they are at the point they're at right now, which again is a high, I guess there's a question of whether somebody can wait for a bit of a pullback to buy in, or whether they should just buy in where they are today. Right.
So we own it. We're buying it for new clients today. And if you own a stock, you're basically making a decision to buy it. For us, we have to see a 10% annualized return over a 5-year period to justify holding or buying a stock. And we see that with Goldman. But I have to admit, are the shares as cheap as they were 5 years ago? Absolutely not. So, the upside will be, slower growth going forward, but still for us a core hold.
Okay, and you're still buying for customers today?
Absolutely.
Got it. Okay, let's go to Luke on the line. He's in Comox, BC with a question. Hi, Luke.
Yes, good afternoon. I've been waiting patiently to get into Amazon and gap down today after earnings. Do you think it's a good time for entry?
Okay, let's pull up the line chart for Amazon. $200 billion is their AI spend just this year, $50 billion more than estimated.
And even today, that's a lot of money.
And so it's unimaginable. Investors don't like that. Obviously, they sent the stock packing, but would you buy in?
So we own the stock. We're buying it here. Absolutely. And I think one of the things that is possibly getting missed through some of this is this idea that some of these companies are just throwing money out there to keep up with everybody else. Amazon has reason. They have, AWS is one of the 2 largest cloud companies in the world with Microsoft Azure. And they need to spend a ton of money to meet customer demand. The question investors are asking is, will they get a good enough return on this investment to justify all the spending? When you speak to them, they really don't have a choice. They have to meet this demand or they're just going to lose market share over time. There's already a backlog in the industry. So we are comfortable. I mean, there's a lot to Amazon. It's a massive business. It's probably going to be the first $1 trillion revenue business in the next 2 or 3 years. There's continues to be huge growth across the Amazon core of businesses. And so for us, we feel we need to be there. We like the company. They're brilliantly managed. It is a behemoth, and they keep on, eating up other industries. I've always said I would never want to be in an industry that Amazon's competing in. And this is a day to buy on Amazon.
That being said, on the retail side, Walmart's doing really well, even though it was lagging behind for so long with its online sales, but it stepped up its game.
Sure, and these major players, the bottom line is they're eating the lunch of a lot of small companies. So, Amazon is continuing to deliver double-digit growth. This is a $700 billion revenue company. 10% growth is $70 billion of new sales in a year. Sure, Walmart's, gaining sales. A few others are, but, where are these sales coming from? They're often coming from other smaller competitors.
Okay. Let's get to an email then from Terry. He says, recently you recommended Disney. Why? Do you still recommend Disney? Is a question coming from Terry. Disney just got new ownership. Are you still liking Disney?
I hate people with long memories. I'm just kidding. We like Disney. For us, Disney is an incredibly cheap stock. Listen, they have botched their CEO transition for the last few years. Hopefully, this transition works out well. They promoted the fellow who's running Disney's most profitable.
Inside, yes.
And he runs their most profitable business, which is actually a theme park business. That being said, Disney streaming became, earnings positive last year. So free cash flow positive. The whole ESPN business, we think they're on absolutely the right track. And ESPN is going to be able to drive forward the streaming platforms, already having an impact on earnings. And so at the price you're paying, you're getting, an iconic company with an unbelievable catalog. There'll be a streaming winner, and you're buying it for less than 20 times earnings. It is cheap. That being said, this management transition, the new fellow is going to be under the gun, and people are paying a lot of attention. But the stock is cheap, and they have unique products.
Okay. Let's take another quick break. We will be back with more of your phone calls for Lorne in a moment. Stay tuned. Welcome back. Let's go to Rafi on the line in Toronto with a question today. Hi, Rafi.
Hi, Marilla. Hi, Lauren. Thanks for taking my call. Understanding that competition in the chip sector is there's lots of competition, and appreciating the concerns about this company's high valuations, ARM Holdings still beats on top and bottom lines and continues to surpass expectations. Is this not? Does it not make sense to pick this up on a pullback?
Okay,
Your thoughts,
thank you.
please.
Thank you for the question. How do they do in this space? Because he's right. There's a lot of competition.
The chip business is a very tough business, especially chip manufacturing business. We own TSMC, which is, of course, they make all the chips for NVIDIA, Apple, et cetera. And, even TSMC, that business has historically been a very cyclical business. Okay, it's on this massive upswing for the last few years, but this has been a cyclical business. These companies invest tons of money, and then as soon as, chip demand stalls a little bit, chip prices fall, and they, don't make as much money as they had. So, we're sticking with what I would call, the best of the best. Mm-hmm. But I have to say, ARM Holdings has been a home run. They've done a spectacular job, brilliant management, let me say. We don't own it. I have only, incredible respect for what they have done. Here's why we own TSMC, but they might indeed be give a better return over the next couple of years.
So how do they compete against some of these big guys? Are they gaining any market share?
They're more specialized. So they're a more specialized company. TSMC is kind of more that mass market chip, and they're the cutting edge AI chips, which is why NVIDIA and Apple, they're the sole supplier. But like I said, ARM's done a spectacular job and has been brilliantly run.
Okay. Let's go to our next email from Hannah. She says, what are your expectations for both Robinhood and Bitcoin? I was looking up Bitcoin. I know it was down to like 65 yesterday. We'll take a look at where it is today. Are you interested at all in Bitcoin? Is it something you have dabbled with at all?
I have to say, Marilla, I know nothing about Bitcoin, and I never understood why anyone else, except a drug dealer or something, would want to transact in Bitcoin. And this last little while is the perfect example of why has Bitcoin suddenly fallen 40% or so. No one even understands fully why. Why did it rise? This is a purely speculative investment. I would tell anybody, don't ask Lorne Steinberg to be the expert, because I am not. But it's probably not the kind of thing you would want to mortgage your house to invest in. So if you think this is a place to be, do so in a very small way.
Okay. What about Robinhood?
And Robinhood, to me, is kind of the other side of the speculative, perhaps bubble space, okay? Because a lot of people it's basically in some ways a gambling platform. People are, day trading on this and buying all kinds of things.
Pile out all the time.
Exactly. And they'll make money on volume, and then these things fall off, and look what happens to the stock price. So not our kind of thing, not for conservative investors or anybody with a heart condition, let me say. But, this is just that purely speculative side of the market.
Okay, which you stay away from.
Which we're boring. We stay away from it.
Okay, let's go to the phone lines. And Mike's on the line. He's in Toronto. Hi, Mike.
Hi, thank you very much for taking my call. Mr. Steinberg, I know Toyota reported earnings today, and my question for you is, do you see any value in either Toyota or Honda, or do you think that they might be value traps? I'll hang up and listen to your answer. Thank you very much.
Thank you for the question. Wow, auto space is kind of a hard one today.
We don't own auto stocks, but let me say I read a book 30 years ago by Marianne Keller, a top auto analyst, who predicted that Toyota was going to be the most successful auto company in the world. She was right. And Toyota's brilliance is they basically stayed away for the most part from the EV business and focused on the hybrid business, which has been a better place to be. They are probably the most rock solid of all the automakers. Listen, this is a capital intensive business. It's not our kind of business, but Toyota's done a spectacular job, and they've been the winner. And I wouldn't call it a value trap, but it's so sensitive to the consumer spending.
What about tariffs and how that has affected the industry?
It's hard to. So Toyota makes a lot of stuff in the States. Toyota's done a great job about making cars where they sell cars. So I think they're less impacted by that, but they're all going to be impacted by supply chain. So if there is no Kuzma agreement, if Donald Trump demands that cars be made in the States, all of the automakers that sell cars in the States, all of the majors, it's going to cost them tens of billions of dollars to build new factories. It's going to cause car prices to rise. That's why we don't believe it's going to happen.
Okay. Let's get to an email from Robin. She says, hello, what do you think about getting into Shopify, which is always volatile and has been off lately? Do you like Shopify?
One of Canada's great success stories. Love the company. The management these are geniuses. But I have to say, even with the fall off in the share price, the shares are trading for 60 times earnings, 60. It is too expensive for us. It is, I won't call it speculative, but you're betting on continued huge growth, and we're just not ready to make them. And also growth looks like it's going to start moderating, partly just law of large numbers. This company, passed $10 billion of sales and more, and it's tougher to keep on growing top line at that rate.
Okay. There's Shopify. Let's take a quick break. We're back with new picks from Lorne in just a moment. Join us on Monday for Market Call. Brian Madden with us on the show, Chief Investment Officer at First Avenue Investment Counsel. He'll take your questions on North American equities. That's on Monday. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time now for new picks from Lorne. We're going to start with Kimberly Clark, KMB on the NASDAQ. Not a name people may be familiar with, but the products people definitely know.
Sure. I mean, Kleenex, Scott's Tissues, Huggies, Diapers, Kotex, these are all iconic brands. Kimberly is trading at a 10-year low, actually, Marella. It has been a boring, minimal growth company trading at a cheap valuation of 13 times earnings with a 5% dividend yield. They have been a dividend stalwart with over 50 consecutive years of increased dividends. That being said, the company is about to change dramatically as they're merging with Kenvue, which was the old Johnson & Johnson consumer products. So they're going to add all the Johnson's baby products, Neutrogena, Aveeno, Band-Aid, etc., and to create the largest consumer health company around and personal care product company around. And there should be huge synergies here. We expect to see earnings growth rise relatively quickly after the acquisition, and the stock to be worth a lot more than it's trading for today.
Okay, Kimberly Clark there.
And you're getting a great dividend.
And you're getting, it's 4.9, I believe, is what the dividend's at. All right, let's get to your next pick, Microsoft. Beaten up lately, MSFT on the NASDAQ. Again, people are unsure about A, software moving forward, and B, spending on AI. Microsoft reported earnings and immediately started to sink. Are you picking it up here?
Oh, absolutely. Listen, Microsoft, first of all, has been an incredibly disciplined company when it comes to capital spending. I mean, they're incredibly well run. We expect they're spending the money wisely. Second of all, Microsoft, of all of the software companies, they are at the nexus of software, cloud, and AI. Like they've put this whole package together. They are an important part and the major vendor to every major company, basically anywhere. And we forecast Microsoft earnings to rise over the next 3 years by at least 50%. And this company to remain a double-digit grower. They are embedded in everything and everywhere. And they are brilliantly managed as well. They also own LinkedIn, as you know, and they've taken a losing company and turned that into a profit generator. So for us at 24 times earnings, this is a great opportunity to buy the best of the best.
Okay, let's get to your last pick here, which is Lind, PLC, LIN on the NASDAQ, which is a gas company.
Sure, no one's ever heard of Lind, yet they're they're the largest company in their field. They've got like a $200 billion plus market cap. They are an industrial gases company, which sounds like a boring area, but it is a growing area. And every major manufacturing facility for petrochemicals, food, beverage, healthcare, there is a gas facility, an industrial gases facility beside it. And when you get these contracts and you've built the facility, it's almost impossible to knock you out because if someone else comes in, they're going to have to rebuild that facility. Lind is the best and the biggest, and it's an oligopoly. There's 3 major competitors. They're the largest, and they've just been able to consistently deliver excellent earnings growth. They've been a huge buyer back of their own shares through with their free cash flow, pay a small dividend. They merged with Praxair in 2018 to create this entity. Brilliantly managed, but it's also a growing area.
I was going to say, what interests you now about this company?
It's a growing area because things like hydrogen are being, used and will be used more for so many different kinds of very intricate processes. And this is a business where it's impossible, almost impossible, barriers of entry are so high for someone else to get into.
Okay, and do they have that capacity to grow?
Sure, they've also been, a buyer of other smaller companies that fit in well. They've got the free cash flow, and when you're the largest, you also got the technical know-how as well. There's very little competition for them.
Okay, so that was Lind. I have one backtrack question for you. It has to do with Amazon versus Microsoft, because you like them both. And all of them are getting hit by capital X spending. And I'm wondering, are there room enough for all with the amount of CapEx they're each spending, or is one of them going to fall?
So I don't think any of these 2 companies are going to fall because.
But in the Mag 7, generally.
It's really hard to say. It's really hard to say because they're spending all of this money because they see immediate demand today. So they're going to meet this demand. But 1 or 2 years of fulfilling demand is not going to justify the CapEx that they're putting out there today. So, one has to have the confidence or make the bet that these companies, which have brilliant people working there, know what they're doing and are going to spend the money wisely enough to get that return. But it's early days, and it's a great question, and no one fully has the answer to.
Okay. That answer to come. Lorne, thanks for joining us. Have a good weekend.
Varela, thank you so much.
All right. And thank you for joining us today on Market Call. We'll see you back here again on Monday.